Hey there, money-minded friends. Today we're diving into Genting Singapore's wild ride. Their stock has dropped 23% in just 1 year. Ouch. Most people think this casino giant is in serious trouble. But what if I told you there might be hidden opportunity behind all this doom and gloom? I've been analyzing Singapore stocks for years, and today I'll walk you through exactly what's happening with Genting. The good, the bad, and what it means for your money. Let's get started. Hey friends, welcome back to the channel. I'm Iggy, and I love talking about stocks, finance, retirement planning, and all things wealth building. Quick update. The Investing Iguana recently ranked 8th in Tiger Broker's 2024 Influential Tigers list. We've hit over 768,000 reads and 53,000 likes. After making more than 700 videos with over 300,000 watch hours, I'm still as excited as ever to break down these market moves for you. And yes, we're still keeping a close eye on what's happening in economies across Asia and the world. So, Genting Singapore. If you've visited Singapore, you probably know Resorts World Sentosa, the massive complex with Universal Studios, hotels, restaurants, and yes, a casino. But their stock has been on a downward slide. Let's figure out what's going on and if there's light at the end of this tunnel. First, let's look at their recent performance. Genting's 2024 results were a mixed bag. Revenue went up by 5% to $2.5 billion. That sounds good, right? But here's the problem. Their profit actually fell by 5% to $578.9 million. Think of it like getting a raise at work but somehow ending up with less money in your pocket. Not ideal. What happened? Well, their expenses went up faster than their income. It's like when your salary increases by $200, but your rent, food, and bills go up by $300. You're technically making more but keeping less. The second half of 2024 was particularly rough. Revenue dropped 12% compared to the same period in 2023, and profit plunged by 34%. That's when investors really started heading for the exits. But here's a question for you. Is this just a temporary setback or the start of a bigger problem? Let me know what you think in the comments. For Genting Singapore, everything comes down to visitors. No tourists means empty hotel rooms, quiet restaurants, and a lonely casino floor. The Singapore Tourism Board reported 16.5 million visitors in 2024. That sounds impressive until you realize Singapore welcomed 19.1 million people back in 2019 before the pandemic. It's like throwing a party and having 15% of your guests not show up. The food's ready, the music's playing, but there are empty chairs everywhere. Why aren't tourists fully back? One big reason is Singapore's strong dollar. When you're from Indonesia, Thailand, or Vietnam, and your currency buys less in Singapore than it did a few years ago, you might think twice about that trip. Even visitors from major markets like India and China haven't returned to pre-pandemic levels. Indian visitors were down 13% compared to 2019, while Chinese visitors were still 3% below their previous numbers. The good news? Tourism is expected to grow to 18.5 million visitors in 2025. That's better, but still not quite back to the glory days of 2019. Now here's where things get really interesting. Thailand is moving to legalize casinos. In January 2025, the Thai cabinet approved a draft law that could bring casino resorts to Thailand. This is huge news for the region. Why does this matter for Genting Singapore? Well, imagine you run the only ice cream shop in town, and suddenly someone announces they're opening 3 new ice cream parlors. You'd be worried, right? About 70% of Resorts World Sentosa's revenue comes from foreign visitors. If those tourists decide to go to Thailand instead, that's a major problem for Genting. But here's the twist. Genting isn't just sitting back and watching. They've said they might bid for one of those Thai casino licenses themselves. It's like saying, if you can't beat them, join them. This could be a smart move to diversify their business, but it also means spending a lot of money with no guarantee of success. What do you think? Should Genting expand to Thailand? Drop your thoughts in the comments. Now let's talk about Genting's master plan to turn things around. RWS 2.0. They're pouring billions into upgrading Resorts World Sentosa. It's like giving your house a complete makeover, except this house is already a massive resort with a theme park, aquarium, and casino. Some exciting developments are already happening. Universal Studios Singapore just opened a new Minion Land in February 2025. A super luxury all-suite hotel is coming in the third quarter of 2025. The Singapore Oceanarium will also open around the same time. And a new waterfront development broke ground last November, set to finish in 2030. They're also investing in AI technology to create more personalized experiences for visitors. Management expects earnings to improve once these new attractions start opening, especially from the third quarter of 2025 onwards. But here's the catch. All this construction costs money, a lot of money. And while they're spending on these upgrades, they might have less cash for other things like dividends for shareholders. Speaking of which, for the 2024 financial year, Genting Singapore proposed a final dividend of 0.02 per share, exactly the same as last year. When a company keeps its dividend flat while profits are falling, it can be a warning sign. It's like someone maintaining their lavish lifestyle even after taking a pay cut. You have to wonder how long they can keep it up. Their free cash flow dropped to $437 million in 2024, down 30% from $630.9 million in 2023. That's a significant decline. But here's another way to look at it. Genting is choosing to reinvest in its future rather than returning more cash to shareholders right now. It's like a farmer setting aside some of this year's harvest as seeds for next year's crop. The question is, will these investments pay off? And how long will shareholders have to wait? So after all that, should you buy, sell, or hold Genting Singapore shares? Let's break it down. There are several reasons for optimism. Tourism is recovering, even if it's slower than hoped. The RWS 2.0 upgrades could attract more visitors, and at a 52-week low, the stock might be undervalued. But there are also reasons for caution. We've seen declining profits and cash flow. There's potential competition from Thai casinos, and the company faces high capital expenditure needs for the next few years. Here's how I think about it. Genting Singapore is like a house under renovation. There's dust everywhere, the noise is annoying, and it doesn't look great right now. But if the renovation goes well, the house could be worth much more when it's done. The key question is, do you have the patience to wait through the construction phase? If you're a long-term investor who believes in Singapore's tourism potential and can wait 3 to 5 years, this dip might be an opportunity. But if you need quick returns or dividends, you might want to look elsewhere. Remember, investing is personal. What works for one person might not work for another. Always do your own research and consider your financial goals before making any investment decisions. Let's wrap up what we've learned today. Genting Singapore's stock has dropped 23% in a year due to falling profits and tourism challenges. Tourism is recovering but hasn't reached pre-pandemic levels yet. Potential competition from Thai casinos poses a threat. Genting is investing heavily in RWS 2.0 upgrades to attract more visitors. The dividend remains unchanged despite declining profits. And investors need patience as the benefits of these investments may take years to materialize. What do you think about Genting Singapore's prospects? Would you buy at the current price? Let me know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more insights on Asian stocks and global investing trends. Let's wrap up what we've learned today. Genting Singapore's stock has dropped 23% in a year due to falling profits and tourism challenges. Tourism is recovering but hasn't reached pre-pandemic levels yet. Potential competition from Thai casinos poses a threat. Genting is investing heavily in RWS 2.0 upgrades to attract more visitors. The dividend remains unchanged despite declining profits, and investors need patience as the benefits of these investments may take years to materialize. What do you think about Genting Singapore's prospects? Would you buy at the current price? Let me know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more insights on Asian stocks and global investing trends. For those of you interested in seeing how Genting Singapore fits into the bigger picture of cash-rich companies, check out my previous video, 2024's Cash Kings, Genting, and Yang Zijiang's Big Win. In that video, I explain how companies with strong cash reserves like Genting can actually benefit from high interest rates and why this might be a hidden advantage in their current situation. Thanks for watching, and remember, smart investing isn't about getting rich quick. It's about making informed decisions that grow your wealth over time. See you in the next video.